Okay, so have you ever wondered how a huge company, one with a massive factory or even just some really valuable software, deals with the fact that this stuff gets older? I mean, its value changes over time, right? Well, it's not as simple as you'd think, and it's actually a huge deal for their bottom line. So today, let's dive into the secret life of value, a world we call depreciation and amortization.
All right, let's kick things off with a little puzzle. Imagine a company goes out and buys a brand new truck for, say, $50,000. Now, why can't they just write that off as a $50,000 expense in year one? I mean, the cash is gone, right? Seems logical. But nope, it's not that simple. And figuring out why gets us right to the heart of what we're talking about today. And the answer to that puzzle is a really important accounting idea called depreciation. Now, the official definition on screen looks a little, well, formal. But let's break it down. It really boils down to two key phrases: systematic allocation and useful life. All that really means is, instead of taking one giant financial hit right away, the business gets to spread the cost of that truck over all the years it's actually out there doing work and helping make money. It's about matching the cost to the benefit.
Okay, so if we're going to track how an asset loses value over time, we first have to figure out what its value is to begin with. We need a starting point, and that means calculating its true full cost, right from day one. So let's imagine our company buys a big new machine. The price tag on it is $140,000. But, that's not the whole story. You can't just drop it on the factory floor and flip a switch. It costs another 10 grand to get it installed and properly set up. Accounting rules are really clear on this. You have to lump all those essential getting it ready costs together. So the real starting number, what we call the capitalized cost, isn't $140K. It's the full $150,000.
All right, our shiny new machine is installed, it's humming along, and it's making stuff. Great. But from the very moment it starts running, the clock starts ticking. It's losing value. So the big question for the accountants is, how do we actually track that loss? As you'll see, there are a couple of different ways to go about it.
I love this way of thinking about it. Depreciation is the financial echo of wear and tear. It's not just poetic, it gets to a super important accounting rule called the matching principle. The whole point, the entire goal, is to match the expense of the machine with the revenue it's helping to create in the very same year. It just gives you a much, much more honest look at how profitable the company really is. So here are our two main paths. On one hand, you've got the straight line method. It's super common, mostly because it's just, simple and predictable. It's like saying the machine loses the exact same amount of value every single year. Easy. But then there's the reducing balance method. And this one is often a lot more realistic. It gets that a machine is at its absolute best when it's brand new, right? So it makes sense to have a bigger expense in those early, super productive years.
Let's see this straight line method in action with our machine. Okay, so starting cost $150,000. We figure it'll be useful for about 5 years, and at the very end, we can sell it for scrap for maybe $10,000. So the total value we're going to use up is the $150K minus that $10K scrap value, which is $140,000. Simple enough. Then you just divide that by 5 years, and voila! You get a steady, predictable $28,000 expense every single year.
Now, let's look at the other path, the reducing balance method. The thinking here is totally different. Instead of a flat dollar amount, we use a fixed percentage. For this example, we'll use 30%, and we apply it to whatever value is left on the books each year. And just look at the difference. Year 1, the expense is a whopping $45,000. But by year 5, it's way down to around $10,000. See how it loads that expense up front? It really reflects the reality that the machine is doing its best work right at the beginning. So, fast forward a few years, our machine has worked hard, but now we're at the end of its story with our company. It's time to either sell it off or just scrap it. So, what happens on the books now? Let's cook up a quick scenario to see how this works. We're going to sell our machine, and just to keep it simple, we'll stick with the one we depreciated using that nice, easy straight line method. And let's say we sell it at the end of year 3. First thing we have to know is its book value. That's just the official value it has in our accounting records at that moment. And if you remember our straight line table, after 3 years of writing it down, the machine is officially worth $66,000 on paper. Okay, so we put it on the market, we find a buyer, and we end up selling it for $70,000. Pretty good.
So, simple math here. We sold it for $70K, but it was only on our books for $66K. That means we made $4,000 more than we thought it was worth. So we have to record that as a $4,000 profit on the sale. It really shows you that book value is just an educated guess. Because it can absolutely go the other way. What if we only got $50,000 for it? Well, then we would have had to take a $16,000 loss on that sale.
Okay, everything we've talked about so far has been about physical stuff, right? Machines, trucks, things you can kick. But modern companies own a ton of valuable stuff you can't touch at all. The real ghosts in the machine. And this is where things get super interesting and very, very modern. I mean, think about it. What about custom software or a patent for a new invention? These things don't wear out or rust, but their value definitely has an expiration date. So how on earth do you account for that? Well, we call these intangible assets. They can be unbelievably valuable, but they have zero physical form. And honestly, this is where so much value is in today's economy. We're talking about things like patents, copyrights for movies, famous trademarks, all that good stuff. And here is the big reveal, which is actually super simple. For stuff you can touch, like our machine, the process is called depreciation. For stuff you can't touch, like a patent, we do the exact same thing. We spread its cost out over its useful life. We just call it something different. Amortization. That's it. It's the same concept, just a different word. Seriously, that's the whole trick. Let's say a patent is legally protected for 10 years. The company will just take the cost of getting that patent and spread it out evenly over those 10 years. Again, it's all about that same matching principle, matching the expense to the time it's generating value. So let's tie this all together. At the end of the day, it doesn't matter if we're calling it depreciation for a forklift or amortization for a brand name. The goal is 100% the same. It is all about painting a true and fair picture of how profitable a company is by perfectly matching the cost of an asset to the revenue it helps bring in over time. And that just about wraps it up. But I want to leave you with one last thought. We've been talking about company assets this whole time, but what about your assets? The skills you're learning, the knowledge you're gaining right now, that's an asset. So here's the question. What's the depreciation schedule on the skills you're learning today? And are you reinvesting in yourself before they go out of date? Something to chew on. Thanks for joining me.